Let's set the stage for what you do. Just a couple of numbers to help our audience get their arms around this. About $30 billion under assets under management as of the end of the year. 300 plus employees, 100 portfolio companies around the world. Is that about right? And names that people know, some consumer names, both high tech, Airbnb, Uber, but also my personal favorite, Torchy's Tacos,
Absolutely.
Joe and the Juice. We see those all over the place here in New York City. Growth equity. We talk about it, but what actually is it, and what is it especially versus what we typically think about with private equity?
Great. Well, thanks, Jason, for having me here today. Growth equity sits between venture capital and buyouts. We get involved with companies that are post-revenue stage, let's say $20 to $50 million in revenue, growing rapidly, and before they hit the maturity stage where the buyout guys get involved. And these companies are growing typically 20, 30% or greater and are really at the steepest part of their growth curve. And we believe that those are the companies that have some of the most difficult challenges in scaling their business and dealing with the challenges of growth. Venture capital is primarily pre-revenue stage investing.
Right.
As an asset class, we've got about $600 billion of capital in growth equity. And despite the fact that venture capital grabs most of the headlines, it's actually growth equity that's delivered the investment returns by backing companies, as you mentioned, like Uber, Airbnb, and others.
And I want to get to sort of where some of those companies are, because unicorns, they are charging into the IPO market, it feels like this year. We'll see. But where does it sit in terms of the return structure? Yeah, capital versus PE. Where does growth sit?
Sure. We basically target returns in the high teens and have been able to achieve that on a net basis to our investors with a very, very low loss ratio. Our loss ratio has been below 4%. So because we're investing in profitable revenue-generating companies, we don't have the kind of hits and misses that the venture capital industry has either. We also don't use leverage, which is a big difference between us and buyouts. Buyouts, as you know, are really driving a lot of their investment returns quite successfully by employing leverage and operational efficiency. We're much more about driving growth. And our companies last year had a median growth rate of about 28, 29%. So it's that growth that's driving the investment returns that we're seeking.
Right. All right. So the buyout guys over the past few years and other investors, they've taken notice of this. As you mentioned, $600 billion in the aggregate in this strategy. Competition usually makes it a little bit harder to do your job, right?
Well, always, and I think people have discovered the space, both investors who've provided capital to us, but we do have competitors. Some of the venture guys have built growth platforms that have come up market, and some of the buyout firms have created growth platforms and come down market into our space. But
most notably TPG, who has had some of its best successes, it feels like, over the past few years out of its growth portfolio.
They have, and I think
they're an Uber with you.
I think people have recognized that this is a great source of growth, secular growth and secular return that fits well into an institutional portfolio. So we do have company, but fortunately it's a very big space. It's global in nature. About 60% of our activity is outside the U.S. We've built platforms in China, India, Latin America, and even Southeast Asia, because we're seeing a true globalization of entrepreneurship. And when we talk unicorns, they're all over the world now. They're not just in the U.S. and Silicon Valley.
All right, so let's talk unicorns. Let's talk more, because IPOs on the deck for Lyft, potentially Uber, Slack. That's another name you're involved in. Others may come out. What's the market going to be like for them? Hotly anticipated.
Yeah, I would say two things. I think 2019 is setting up to be the most exciting IPO year since 2012 for a couple of reasons. You've got some wonderful companies. One, Uber, Lyft, and maybe down the road Airbnb are going to introduce investors to the sharing economy and the very, very large rideshare market. And then on the enterprise software space, you've got Palantir, CrowdStrike, Slack, all highly anticipated next-generation software companies. You got to go all the way back, I think, to 2012 when Facebook went public and introduced investors to the social media space. And also, we had that great crop of cloud software companies, Workday, ServiceNow, Palo Alto Networks. So it's setting up to be a great year. The other thing about the IPO market that we've observed over the years is that when you have a very constructive equity market like we've had over the last several months, combined with moderate volatility, a VIX of 15, the market's not too hot, not too cold, really creates the best conditions for a good IPO market, and we have them now. We've seen the Levi Strauss deal work. I think Lyft will be successful, and I think it sets up a nice conditions for the balance of the year.
All right, nice conditions to exit. What about getting into deals? How much do you worry about valuations in this sort of Goldilocks market?
Well, private market values are up. There's no doubt about that, and it makes our job more challenging. But you've always had to pay full prices for great growth companies. That's not any different today than it's been in the past. The key for us is actually discerning companies that really can emerge as market leaders and secondarily are serving very, very large markets. And when you get that right, history tells us you can get your investment returns even if you're paying a full valuation. Where you get into trouble is if companies that really at the end of the day are serving relatively small markets relative to the enterprise value you're being asked to pay.
All right, so let's talk a little bit about the firm. As we said, it goes all the way back to 1980, sort of came out of a family office type situation. Duty-free actually is underneath all of this, right? A fortune there.
Yeah, we have a wonderful history that I feel very fortunate to be part of. We were founded in 1980 by a man named Chuck Feeney, who was the founder of the duty-free shopper business out of Cornell, and actually built that into a very successful company, and we were really formed to manage his capital.
Yeah.
And between 1980 and 1990, we were a family office, and he was our sole source of capital. Around 1990, Chuck, who really is the father of the Giving Pledge, gave all of his wealth to Atlantic Philanthropies, which now, during the balance of his life, he's in his late 80s, he's really a special man, has given away almost $9 billion to causes around the world, including here, the Cornell Technion campus, and out in San Francisco, the Mission Bay campus for University of San Francisco.
All right, we're going to get to some of your philanthropy in just a minute with talking some hoops. But before we get to that, you're also involved in the Partnership for New York City, a very active voice. You're co-heading it with Ajay Banga, I believe.
Yes.
You guys have been very involved, especially on the back end of that decision by Amazon not to come to New York City. Where do we stand on that? Is that still live?
Well, Ajay and I, and with Kathy Wild, who heads the partnership, have really tried to basically turn around Amazon's decision. We've stayed engaged with both the local community, our local politicians, our governor, as well as with Amazon to see if we can turn this around. We're worried this sends a negative signal to business globally about doing business here in New York. And New York had great momentum in the tech space. If you think about it, Facebook has a campus here, Google has a campus here. We have our share of leading companies, Infor, Squarespace, MongoDB and Etsy are unicorn IPOs. So the space had momentum, and I think adding Amazon would have only distinguished New York as a leader in technology. Also media, given Amazon's move into media, New York is obviously a great media hub. It would have been another a catalyst for the development there. So we hope we can turn it around. Yeah. And if we aren't able to, we still want to send a really strong signal to the global business community that New York wants them to operate here, wants them to build their business here.
Do you feel like it's working so far? Are they listening to you? How engaged?
Well, we know we have to elevate our voice, and we have a great group of people who are part of the partnership, and we've come together and said we need to be more active and more vocal, and we need to engage our employees, because actually when we did a survey in New York, and 70% of New Yorkers said they wanted Amazon to be here, and we just aren't activating that voice loudly enough. So That's something we need to do.
All right. Got to talk some hoops. Brackets for a Cause. You've been involved for the past few years. You're a past winner. You and Tillman Fertitta split the prize a couple years ago. You're in 5th place right now in some good company. Back in the day, I believe you rode UNC all the way. This year, you've got Duke. A lot of people have Duke. How you feeling?
I feel great about Duke winning the whole thing. First of all, it's one of my favorite times of year. Brackets for a Cause at Bloomberg is just terrific. It's now, 54 contestants this year, and it's a great field. Congratulations to Dwight Anderson for getting 16 of the Sweet 16. Hard to believe that our team got 15 out of 16 right, and we're hanging on to 5th place. So This is a super competitive field this year. We just think it's Coach K combined with probably the best college basketball player in Zion Williamson is hard to go against, and we think they've got a good chance to win.
And importantly, Shining Hope for Communities, that's your charity. Again, tell us about what that is.
Yeah, Shining Hope is a terrific social service organization that runs girls' schools in some of the largest slums in the world, which are in Nairobi, Kenya. And they've had an amazing impact. In fact, they sent their first crop of graduates to college last year. So it's a wonderful organization. That's where the proceeds went 2 years ago. And hopefully we can get some money to them again this year with a come-from-behind victory.
So a group effort to get this bracket together? You got a good team working on this?
We've got four terrific associates at General Atlantic. Each took one of the regions, and we used a private equity decision-making style, lots of conference calls, lots of debate when we got to get to our bracket.